Taxes can take a significant chunk out of a person's earnings, but certain legal strategies allow individuals to reduce their tax burden. One such strategy involves real estate investing, specifically short-term rentals. There is a lesser-known loophole in the tax code that allows real estate investors to classify their rental losses as active rather than passive. This classification enables them to offset their income from other sources, potentially reducing their tax liability by tens of thousands of dollars. Investing in real estate comes with various tax benefits, making it a preferred investment strategy for many individuals. Real estate investors can deduct several expenses, including mortgage interest, repairs, maintenance, property management fees, and even costs related to marketing their properties. These deductions help reduce taxable income, making real estate investing an attractive financial strategy. One of the most important deductions available to real estate investors is depreciation. This deduction allows investors to account for the gradual wear and tear of a property over time. Instead of deducting the entire cost of the property in 1 year, the value of the building structure is divided over several years, reducing taxable income annually. However, real estate depreciation has specific schedules. For residential properties, the standard depreciation period is 27.5 years, while for commercial properties, it is 39 years. This means that an investor who owns a residential property worth $1 million can deduct only a fraction of the property's value each year by dividing the total amount by 27.5 years. While this depreciation schedule provides some tax relief, it limits how much an investor can deduct annually. To understand why the short-term rental loophole exists, it is essential to look at tax reforms from the past. In 1986, the U.S. government passed the Tax Reform Act, which introduced the passive activity loss rules. These rules were designed to prevent high-income earners from using real estate as a way to shelter their income from taxation. Before this reform, wealthy professionals such as doctors and lawyers could invest in real estate and use their real estate losses to offset income from their primary jobs. The 1986 tax law categorized real estate investing as a passive activity, meaning that losses from rental properties could only be used to offset rental income, not income from a full-time job or business. As a result, many investors found themselves unable to take full advantage of their real estate deductions. However, despite the strict rules, the government left a few key loopholes in place. One of the most valuable ones is the short-term rental loophole, which allows investors to bypass passive activity loss limitations under certain conditions. The short-term rental loophole allows investors to classify their real estate losses as active losses instead of passive. By doing this, they can offset their losses against their W-2 salary, business income, or even capital gains. One key condition for the short-term rental loophole is that the average guest stay must be 7 days or less. Alternatively, if the average stay is under 30 days, the owner must provide significant services, similar to a hotel, to qualify. Additionally, investors must meet IRS material participation requirements. The reason this loophole exists is that short-term rentals require significantly more work than long-term rentals. Unlike a traditional landlord who rents out a property for months or years at a time, a short-term rental owner must frequently check in guests, handle maintenance, and manage bookings. The tax code recognizes that this type of real estate investing is more like running a business rather than simply collecting rent, which is why it allows short-term rental income to be classified as active income. Initially, this rule applied mostly to businesses like bed and breakfast, hotels, and motels. However, with the rise of platforms like Airbnb and VRBO, short-term rentals have become much more common. Today, investors can take advantage of this loophole without owning a hotel or a large hospitality business. While the short-term rental loophole already offers substantial tax savings, investors can take it even further by using accelerated depreciation. Normally, properties depreciate over 27.5 or 39 years, which means only a small portion of the property's value can be deducted each year. However, there is a way to speed up the depreciation process, allowing investors to take larger deductions sooner. This is done through a process called cost segregation. A cost segregation study helps investors break down the value of their property into two categories: structural components, such as walls and the roof, and non-structural components, such as appliances, furniture, and carpeting. Non-structural components typically have a shorter depreciation period, often between 5 to 7 years instead of 27.5 or 39 years. By categorizing parts of the property into these shorter schedules, investors can accelerate depreciation and claim larger deductions in the early years of ownership. For example, if an investor owns a short-term rental property worth $500,000, a cost segregation study may allow them to classify $125,000 worth of assets as short-term depreciation items. Instead of spreading this amount over decades, they may be able to deduct it within the first few years, significantly lowering their taxable income. To successfully use the short-term rental loophole, an investor must prove that they are actively participating in managing their rental property. The IRS has specific material participation tests that determine whether a real estate investor is actively involved. There are 7 different tests, but the most commonly used one is the 100-hour rule. This rule states that the investor must spend at least 100 hours per year managing the property, and no one else can spend more time managing it than the investor does. This means that if an investor hires cleaners, handymen, or property managers, they must ensure that their own involvement in the rental, such as handling guest communications, marketing, or maintenance, is greater than that of any hired help. If an investor meets this requirement, they can turn their passive real estate losses into active losses, allowing them to offset income from other sources and dramatically reduce their overall tax bill. The short-term rental loophole is one of the most effective ways for real estate investors to legally reduce their tax burden. By classifying their rental income as active and utilizing cost segregation studies, investors can potentially eliminate tens of thousands of dollars in taxable income. This strategy is particularly beneficial for high-income earners, such as business professionals and entrepreneurs who are looking for ways to minimize their tax liabilities. However, even individuals with moderate incomes can benefit if they structure their investments correctly. It is important to note that while this loophole provides significant tax savings, investors must follow IRS guidelines carefully to ensure compliance. Maintaining proper documentation, tracking hours spent managing the rental, and conducting a cost segregation study are crucial steps in successfully implementing this strategy. Real estate has long been considered a powerful tool for building wealth, but when combined with strategic tax planning, it becomes even more valuable. The short-term rental loophole is a prime example of how investors can leverage existing tax laws to their advantage, reducing their tax burden and increasing their overall returns. For those considering real estate investing, understanding and applying this loophole can mean the difference between paying tens of thousands in taxes or legally keeping more of their hard-earned money. With proper planning and execution, short-term rentals can be both a lucrative investment and a powerful tax-saving strategy. If you found this video helpful, make sure to like and subscribe to the channel for more in-depth real estate and tax-saving strategies. Also, don't forget to hit the notification bell so you never miss an update. If you're serious about maximizing your tax savings and want personalized guidance on how to implement this strategy, visit my website. I offer one-on-one consultations to help you navigate tax laws, structure your investments, and create a strategy tailored to your financial goals. Click the link in the description to book your consultation today.